Raising startup funding can feel like a total mystery, unless you've lived it from both sides of the table. I've been both a VC-backed founder raising $16 million dollars and a venture capitalist as a seed and Series A investor. So I've seen exactly what works and what doesn't when raising startup funding. So in this video, I'm going to show you if you should raise VC money at all, what to watch for at every stage, and the practical steps that you need to take to make sure you get the funding to build the business of your dreams. So first, I just want to talk about if funding even makes sense for you, so you don't make the same mistake so many founders make, wasting precious time on the wrong things. Because I've seen that startups in 2025 fall into three main buckets regarding whether it makes sense to raise a startup funding or not. And these three buckets are, the first one is this big, crazy growth story. You're thinking 1 million, 2 million, 10 million, $20 million rounds, and the shot at getting bought or going public. Think of Facebook, Amazon, all that kind of stuff. That's what VCs want. They want big returns, fast exits, dominating the market. Otherwise, they're just not really interested. And if an investor can't feasibly see a route to make at least 100x on their investment, they just won't invest into you. Now there's the in-between group, which has become a lot bigger in the last year. I don't actually necessarily agree with, to be honest with you, but think of it like raising just enough to get off the ground. So you're not chasing unicorn status, you're just trying to raise a little bit, and it's called seed strapping. It's scrappy, it's not all in the VC style, you're just trying to raise a little bit of money to prove and then carry on growing your business. And lastly, you've got what most businesses are, which is you've got a steady, sustainable business. Maybe it's more about freedom and income, not scaling to the moon, and just creating a lifestyle business that actually works for you. Outside funding doesn't make sense for this, and you're wasting your time trying to get investors when they're just not going to invest into you. Because trading a huge slice of a huge company for total control of a small one isn't worth it. And investors are just not going to invest into that. So you need to be honest with yourself. Are you building something VC backable, or are you aiming for stability and control? Does owning 20% of a $100 million business or $1 billion business make sense for you? Or would you rather own 100% of a 1 to 5 million business? Which one of these makes the most sense for what you want and what the business actually needs to grow? Because if you're gunning for huge growth, if you're dominating the market, you have to dominate the market. If you need loads of money for technology, then yeah, outside money, it makes sense. But if it's about freedom and steady income, you need to skip the fundraising hamster wheel. It's not for you. And honestly, either choice is fine. Just be clear on which path is the right for your goals, and don't waste time chasing investors if they're not a fit. But if you are raising money and going down the proper start funding route, how do you set yourself up to actually get in front of the right investors? Well, let's get into it. The best way to start talking about how to raise startup funding is to set the scene of the different stage types in a funding round. Fundraising has 4 different stage types, and they decide where your company has to be at for the round and what kind of funding round you're going to have as well, with whether it's angels or VCs or amount you're raising and all these kinds of things. Now, before we go into it, there are some outliers to this, of course, especially in the AI age, but they are pretty much always fall into these 4 stages unless your company's just going crazy and you raise $10 million on nothing. So you should always be thinking about them in the same way and conducting what you do in the business and your fundraise with these 4 stages as a law. So pre-seed is all about building out and testing your hypothesis. At this point, you might be putting together your MVP or just trying to see if your idea actually works before any real launch. And once you've got some proof that it could work, then you'd move to something called a seed. And here it's time to launch and see if people actually want what you're offering. So you're hunting for those first signs of product market fit. Basically, can this actually survive in the wild? And at this point, you'd be raising anywhere from $1 to $5 million and just really testing if it's going to get to product market fit. If you're seeing traction, you then aim for Series A. And this is where you're going to raise anywhere from 5 to 15, $20 million. And then this stage, you need to prove real product market fit, usually with, $1 million plus ARR, at least a year's worth of revenue, and a strong sense of what's driving your growth. This is where you want to show that you can scale fast and you've tested all of the metrics for scaling that's going to make you successful. Now, Series B and beyond are about the even bigger bets. Now you're proving you can complete your earlier wins and dominate your market. Think $8 million plus in revenue, 20, 30, $40 million as a fundraise, and really starting to pull ahead of competitors. And the best way to sum it up is what you're doing is within the pre-seed you're building, you're then moving into a launch and really understanding if it works in the market. For Series A, you've understood that and you've launched, and now the whole point of it is to actually show the testing you've done within the seed to scale really fast. And then a Series B plus, you're dominating. You're showing that you can dominate this market, and each stage sets you up for the next. And investors want to see that clear progression. And honestly, talking from an investor point of view, this is where most startups get stuck, right between rounds. They run out of money before they can hit the key milestones that the next stage demands. And fundamentally, investors see this all the time in their portfolio companies. And they get really good at spotting it early. I always saw it. It was so easy to see. And that's why one of the first thing any investors looks for is whether you have a clear path to the next round or if you're likely to hit a wall. It was a massive reason why when I was an investor, I used to reject companies, was because I couldn't see that the founder would be able to hit that next stage. I didn't think they'd be able to go from seed to Series A. And that chasm was a big reason why I decided to say no. And if an investor senses that it won't get to the next stage, they'll just pass. And it's not just about the business you built so far, but whether you can keep building and actually unlock that next level. And once you understand these stages, you really understand that a huge part of raising startup funding is showing investors, here's exactly where we are. Here's how we'll hit that next milestone and the next stage. And by the way, here's the big vision behind of it. And when you understand those stages, you can then set up what you need to do in your funding round within the business, with the way you actually talk about the milestones in the future, that's going to set you up and actually make you raise. Now, you'll hear everything I've just said and think, okay, but I'm building in hardware, biotech, deep tech. Isn't that completely different? And yet, for the most part, it absolutely is. Hardware, biotech, all of the ones I said, they're very capital intensive and much slower to revenue to market. Their pre-seed rounds often look like a software startup Series A in terms of numbers, simply because so much money is needed up front. Think of stuff, if you're in hardware and stuff, R&D, prototypes, regulation, burning cash, long before you'll get to market and actually see any type of product market fit. So within these markets and these spaces, investors are not necessarily obsessed with revenue curves. When I was an investor, for example, one part area that I was doing was in biotech. So we weren't necessarily focused on revenue in the next year, right? We were focused on being laser focused on things like their IP or the team's expertise or the growth of it or how defensible the tech is or how big it could be if it is actually successful. They just want to see the clear scientific and engineering hurdles, not just annual revenue recurring milestones. And are you working constantly to get to market, and do they believe you can with the skills that you have? And the biggest thing to remember here, and it comes back to what I was saying at the beginning around how, there are outliers too. So it's also for software, but fundraising stages are more of a shared language rather than rigid rules. So it's up to you as the founder to deeply understand these stages and translate these stages to fit your own startup's reality and what you can do, and then raising along that. And then actually testing the market and seeing what everyone else feels about it. And that's great and all. But how do you actually convince investors that you can get to the next stage? How do you actually raise your round? Well, I think of it in 3 different pillars of how you should be thinking about your fundraise. So when it comes to a fundraising and actually raising startup funding, there's 3 main problems that founders have when they're looking to do a fundraise. Now, the first one is you just can't get enough investor meetings. And what we need to really understand is how do we map out how to get at least 100 plus warm intros and then at least 50 plus meetings with investors. The second thing is you don't actually have a narrative and a story that converts investors. So how do we actually have something that makes people want to take a meeting with you, but then fundamentally actually invest into you? How do we create and tell a narrative that makes investors actually say yes to you? And we have to do those in three different ways. And the last one is you don't have a process. You don't have the milestones, the accountability, and the pipeline to run a structured process that actually makes investors invest into you. Now, when you think of it in these three pillars, really about, do I have enough people to speak to with investors? Am I actually great in meetings that makes them say yes? And do I have a right process? If you can make them work in unison, that's how you raise startup funding. So the biggest thing I want you to think about within this aspect is, which areas of this, of a fundraise, are you maybe worse on? Are you having trouble with finding and meeting investors? Is it because you're trying to just do cold emails, for example? Then you need to think about, okay, how do I improve that? How do I make sure I'm building my network? How am I assembling? How am I running my intros process? How am I running it in the right way to keep myself organized? If it's not that and it's something to do with your narrative, for example, am I actually getting clear and concise and speaking with investor psychology on what makes me great? Or can I influence in the right way? Or can I, am I actually building out a practice system of how I iterate? And this is what's really going to give you the chance of success when you are looking to fundraise. And once you have these all working in unison, that's what's really going to allow you to actually raise startup funding. But once you're ready to take investment, you've really only got two ways to go. You'll either raise using a safe or convertible note, or you'll do a proper equity priced round. So what are these two? So safes and convertible notes, what these are is early stage investors will give you money now, and then those funds will convert into shares at a later priced round, usually when your next big round happens, and usually at a discount as well. The usual is 20% discount, but you'll have a negotiation about that. What these tools let you avoid is arguing about your company's valuation right now, which is perfect in the early days. So when you're raising a pre-seed and a seed, you're most likely going to go down the safe route. Safes are simpler because they have no interest or set repayment date, whereas convertible notes are technically short-term loans that add interest and a maturity date and all those kind of things. So you want to stay on the side of a safe note. Now, equity or price rounds, these will again happen late stages, usually seed, Series A, and definitely Series B. But this is where the investor actually buys shares at an agreed valuation. Now, of course, if you raise safe before, then that's when the other investors will also get equity in you. But for example, let's say if someone invests $1 million for 20% of your company. So how that's going to work is your company is now valued at $1 million post money, because $1 million is they're getting 20%. And then, but $1 million will still be in the business. So pre-money valuation will be the post-money minus how much you raised. So $4 million. Now, a big mistake I see founders make, especially when they don't understand it from a VC point of view, is how shares are actually issued in a funding round. Because you don't just give some of your, 20% of your shares in this funding round. What you'll do is you'll issue just enough shares so that the investor owns 20% after the round. So you'll look at your previous share number, you'll then look at how much is being raised, and then add shares how much that makes sense so they'll own 20% on the end. So early on, most founders use safe or convertible notes to move fast and keep it simple. And once there's more traction and proof, you'll raise a priced round and set the company's valuation. Which one you choose depends on the stage you're raising, and also the investors that you're negotiating with. So there's no right answer to this. You'll do a price round from Series A onwards for sure. Seed and Series A is going to be in between, and then pre-seed as well. But that's everything that you need to know about how to raise startup funding for your business. So before you raise, I just want you to ask three main questions for yourself. What type of business am I building? Do I really need capital, or am I just chasing validation? What stage am I at in the fundraising journey? And have I built out my 3 pillars of fundraising prep to make sure that I can successfully fundraise? Now, if you want to learn in more detail my exact system of how to fundraise for your startup, then check out this next video where I go through exactly how to do it.